Welcome to Delphos Insights. Today, we are analyzing a fundamental shift in emerging market finance, the development of financial technology into an institutional-grade asset class.
Indeed. The scale of this transformation is substantiated by several key data points. India's Unified Payments Interface processed 19.47 billion transactions in a single month.
That is a remarkable figure. Global mobile money platforms transacted $1.68 trillion last year, while remittances to low and middle-income countries reached $685 billion.
That remittance figure is particularly significant because it now surpasses foreign direct investment as a source of external finance. These data points confirm that the digital infrastructure is robust enough to support institutional-scale capital.
This represents the core transformation. What began as social impact initiatives have evolved into profitable, scalable platforms. The narrative has shifted. Financial inclusion is now the primary growth engine of these markets.
Precisely. And this has transformed the capital raising landscape. Funding sources have expanded well beyond traditional venture capital. Two structures are particularly significant: private credit and blended finance.
Could you elaborate on these structures?
The private credit market represents a $280 billion opportunity for fintech funding. These specialized funds provide tailored facilities like receivables-based financing that are often unavailable from traditional banks.
And blended finance?
In a blended finance structure, a development finance institution provides catalytic capital, often as a first loss guarantee. This capital absorbs initial losses, effectively de-risking investments for commercial participants and allowing them to deploy capital at larger scale.
The data shows remarkable leverage effects.
Correct. For every $1 of concessional capital, it mobilizes an average of $2.65 in private investment, a powerful force multiplier.
This brings us to investor requirements. As the sector has developed, what does the investor playbook for 2025 entail?
The standards are exceptionally high. The growth at all costs era is definitively over. Institutional investors operate with a strict checklist, clear licensing and regulatory pathways, rigorous due diligence on unit economics, sophisticated foreign exchange risk management, and strong corporate governance with formal boards and audit committees.
Impact verification has also become critical.
Absolutely. Any stated impact metric must be verified by credible third parties. Delphos' transactional experience confirms these principles. We advised Wave Mobile Money on its €90 million syndicated loan and facilitated a $10.6 million facility for Moxa in Mexico.
These transactions demonstrate practical applications of sophisticated capital structures and investor discipline, creating viable models for financing financial inclusion.
That concludes today's topic. Here's a question for reflection. As fintech platforms become the financial mainstream in emerging markets, what responsibility do they have to ensure they build truly equitable systems rather than recreating traditional barriers? This has been Delphos Insights. Learn more at delphos.co.